Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Pachardez, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be reviewing the week ahead. So Rafi, let's begin with the Reserve Bank of Australia. Earlier this month, the RBA slashed interest rates, partly in response to Australia's second wave. What can we expect from the RBA when it meets on Tuesday? And there's going to be quite a lot of data to look forward to. What's the biggest risk for the Australian dollar in this busy week?
Well, Maria, as far as the Reserve Bank of Australia meeting is concerned, we're not expecting anything this time around. As you said, they slashed interest rates last time. They also significantly expanded their asset purchase program. So they did quite a lot back earlier this month. And we're not expecting any new measures in the near future. So the situation with Australia is that they actually had the second wave much sooner. They had it before Europe and America, and this is likely to lead to a distortion in the third quarter GDP numbers. Other countries saw a huge rebound. The Australian rebound will be much more moderate than other countries because they had to impose new restrictions at the end of the third quarter. Looking ahead, it's looking much more optimistic because, of course, they've now managed to contain that second wave, and plus, in addition with the RBA measures, the fourth quarter should be much stronger. But nevertheless, if we do get somewhat weaker than expected data, that could still weigh on the Australian dollar. Maybe because traders might have gotten carried away a bit lately with the vaccine optimism and just how soon economies will be able to recover. So the third quarter numbers might prove to be a bit of a reality check. And also the fact that the RBA has said that it will now be focusing more on employment. And if the incoming data points to somewhat slower than expected recovery, that could mean a more dovish RBA as well, because even if, say, the gross numbers aren't too bad, if it's not fast enough to generate new jobs, then that would mean more dovish RBA for the foreseeable future.
Okay, turning to Canada now. We've got GDP and jobs data coming up. Do you think the Bank of Canada will make any changes to their quantitative easing program if we get poor numbers, particularly from the employment report? And how about the loonie? Given that it tends to run lockstep with oil prices, how might the outcome of the OPEC Plus meeting affect it?
Well, starting with the GDP data on Tuesday, so we are expecting pretty strong rebound. But we have, it's the case in Europe and America. Canada is also experiencing a second wave, and it's much worse than the first one, at least in terms of the official numbers. So fourth quarter outlook is definitely much more worrisome. So even if we do get a strong GDP print, the investors will be paying more attention to Friday's employment numbers because those will be much more up to date. They will be for November. So any signs of a slowdown in the labor market, a rebound, then that could negatively impact the Canadian dollar. But on the whole, though, the Bank of Canada is unlikely to significantly alter its policy in the near future. So based on that, we might not see a huge reaction for the loonie. At best, we might see some further recalibration on the part of the BOC for their QE program. So there's other factors that we should be watching for the loonie. For one, we have the OPEC meeting, as you said, on early next week. So if they do agree to an extension, and specifically if they agree to a longer than expected extension, say they extend the output cuts by 6 months instead of 3 months, that would definitely boost the loonie. But there are some clouds still hanging over the loonie, for example, because of the Canada's close tie with the US. So there's still question marks whether or not we're going to get more stimulus, both fiscal and monetary stimulus in the US. So until we see until we get more stimulus in the US, that could be holding back the loonie. So although the loonie's outlook is definitely looking much more positive, it's not quite as positive as, say, we've seen for the Australian and New Zealand dollars because of those factors that I just mentioned.
Right. Okay. Now, moving to the US, we'll get the ISM PMIs ahead of non-farm payrolls on Friday. What can we expect from the Fed if employment and jobless readings are worse than expected?
Well, so both the ISM PMIs and the jobs numbers will be very important. There's a lot of speculation, of course, what the Fed is going to do at its December meeting. Everything is pointing that they will ease policy further, but it's not quite certain just yet. And also what kind of measures they're going to announce, whether it's going to be anything significant or not. And so the next week's data will be important. The ISMs in particular, they were very strong back in October. They are expected to moderate slightly in November. If they do come in much worse than expectations, that would almost definitely fuel expectations of strong action by the Fed in December. And the same applies for the non-farm payrolls report as well. Looking at the weekly jobless claims, they've been actually edging higher over the past 2 to 3 weeks. That points to a slowing labor market. So if the non-farm payrolls do rise below what markets are expecting, again, we would see Fed easing expectations surging on the back of that. As far as the dollar is concerned, it's already under quite a lot of pressure. Even if the data does come in below expectations and markets become more certain of Fed action in December, we might not see a huge slide in the US dollar, given that it's already been sold off quite a lot. So that's just one thing to watch out for.
And finally, Brexit talks are still underway, but time is running out. What are the outstanding issues, and what reaction are we likely to see in the pound if no agreement is reached in the coming week?
Well, according to reports, the Brexit agreement, the post-Brexit trade agreement, is about 95% complete. But the remaining areas that still need to be resolved is the fisheries level playing field and the policing of an agreement, or how any disputes will be resolved after Brexit. So those could really are basically make or break issues. So that remaining 5% is really something that is actually, just because it's 95% complete doesn't mean that we're certain to get a deal, and time is really running out. And there's been little progress in those key areas over the past week. Now, talks are expected to continue in the coming days, but if by next week we still don't have any agreement, then we'd see no deal Brexit fears rise substantially. We could see a sharp sell-off in the pound, given that it's already risen quite a lot on the back of those hopes of a Brexit deal. On the other hand, though, the fact that the dollar itself is quite weak at the moment, and also there is some talk that if they don't manage to strike a deal next week, they might go for some kind of a temporary arrangement and then sort out those pending issues at a later date. So although if there's no deal next week, that would definitely trigger a pound sell-off. Maybe it might not be quite as dramatic as you would have normally expected, given the dollar weakness and hopes that there will still be hopes of a temporary arrangement being put in place.
Rafi, thanks so much. And thanks for joining us at XM.com.